Hey everyone, welcome to the KE Report, a daily editorial, Monday, August 18th, chatting with Craig Hemke. Craig is the founder and editor of TF Metals Report. We chat with Craig pretty much every Monday to recap and look ahead to what is going on in the precious metals sector. And not a whole lot has changed since last week, Craig. We have gold last week that went down very little bit. Gold stocks actually consolidated a lot of their gains. They were more or less flat to slightly up for the week. But look, the gold stocks went on just a tear to start off August. And this week, everyone's looking ahead to Jackson Hole and what Powell is going to say because of last week, some of the inflation data that broadly came in higher than expected. So, Craig, because that seems to be what everyone has their eye on this week, on Friday, Jackson Hole and Powell, what are you expecting?
Yeah, that's going to be the big deal. There's some stuff that'll happen along the way. Obviously, the scheduled news that we'll want to keep an eye on, like the flash PMIs, the most recent PMIs for the service sector and the manufacturing sector have been pretty weak. So when the flash ones come out later this week, that'll get everybody's attention. There will be some other data along the way. But yeah, Powell at Jackson Hole, 10 o'clock Eastern, Friday morning is going to be the big event. It will probably set the tone for the rest of the month and into September for the precious metals, or I guess for the dollar index, and then the precious metals by extension. Perhaps that's another way to look at it. There have been, I don't know how many times he's been out there now. This is about, it's going to be his eighth, seventh or eighth Jackson Hole appearance. We're in, and for people that are listening to us, the Kansas City Fed hosts this annual confab of global central bankers in Jackson Hole, Wyoming. They always do it here, kind of mid to late August. And they all always show up and they all give speeches, and they all probably sit around the bar at night and get hammered, but that's a whole other story. Powell in the past has given very interesting and insightful speeches. He's also in the past shown up and given like a 3 to 4 minute talk and got up and walked out. That was 2022, I believe. I would imagine, since one way or another, this is going to be his last meeting that he's going to be doing this. We're going to get a little more depth this time on Friday. I would imagine he'll mainly focus on the importance of central bank independence, given the ongoing stuff he deals with President Trump. But whether or not he'll talk about the latest jobs numbers and the inaccuracy of the U.S. data in that regard, and whether that would have meant that he should have been cutting earlier, and know that they got to start playing catch up. What he thinks about the inflation reports last week, whether he touches on that, whether he talks about what he might be doing. This will probably be the last time we see him until the September FOMC. We'll see what he has to say about rates for the rest of the year. So all precious metals enthusiasts should be watching live if they can Friday morning at 10. It should be quite an interesting speech.
And if precious metals investors can't, definitely check out tfmetalsreport.com and Craig will give his hot take on it afterwards.
Right, immediately almost. You're right. Thank you.
Well, Craig, the question a lot of people have, and I've seen several people weighing in on this in editorials already throughout the weekend and then kick off the week here on Monday, that he should really just focus on the September meeting. And after that, it's going to be Peter Bookvar, our friend, said it's going to be clear as mud at what the economic data is going to look like for the balance of the year. So how far out can they really project? But because it is his last Jackson Hole and the final hurrah for him in that particular role, do you think he will give longer term guidance as far as how the Fed is going to approach it? And then if he hints that they're going to cut as anticipated in September, do you think it matters whether it's 25 or 50 basis points?
Well, I think it would matter that, Shad, in that for now, a 25 basis point cut is pretty well priced in. The odds of it fell off a little bit last week with the CPI data. I mean, a little bit, going from 95% likelihood to 90% likelihood. So everybody's expecting that. You could still, I mean, I should look at my phone. When's the next U.S. jobs report? If I look at the calendar for September, as I'm doing this live, September the 5th. Okay, so we come around to September the 5th, and after the massive downward revisions that we got for, what was it, May and June, this most recent report in July was what, 70 some odd thousand? What if that gets revised down to 17,000? And what if the numbers for August come in poor. I mean, we could be right back to talking about 50 basis points. Remind everybody, Fed cut 50 basis points at the September meeting last year when inflation was higher. So that could come back on the table. But specifically to your question about what he might discuss, I just have a hunch that, I mean, he's going to kind of lay out where he thinks things should go. I mean, he may, in the end, just give just lip service. The way that Trump is browbeating him, he may just go out there and talk a lot about how important it is for all central bankers to remain independent from, politicians and to do the right thing and all that kind of stuff. But we'll see. I can't stress enough. It's going to be the most important thing of the week.
Now, Craig, since the market is really pricing in one rate cut, and we have continued to see the broad averages move higher, we've had yields kind of stuck in a range, maybe arguably the lower part of a range. Does it matter? Does a 25 basis point cut do anything to the markets?
Probably, especially when things are priced in. No. So what will happen is if we just continue this course, and that is what happens. And again, the next Fed meeting is in 3 weeks, or 4 weeks. I mean, September the 17th, I think, is the Wednesday that it'll conclude. So it's a long ways away. Like I said, I can't imagine we'll see Powell again in any significant speech after Friday before that press conference. If it's already priced in, then that whole meeting will be about, what does the dot plot show? What does the summary of economic projections show? What does Powell say and how does he say it in his press conference in alluding to, could there be one more rate cut this year? Could there be 2 more? Anyway, all of that stuff kind of sorts it out. I just would really ask people to, especially if you're curious about gold, silver, not so much, but this year in particular, gold, if you plot it with the dollar index, just print off 2 charts and hold them up to I mean, they're almost a perfect inverse of each other. Dollar fell 10% from about February through April. Gold rallied 25%. But now since the 1st of May, they both pretty much been going sideways. Both of them hovering right around both their 20-day and their 50-day moving averages. So if Powell is perceived dovish, people start, the data is terrible again in September. Not only the jobs report, but that week we'll also get those updated PMIs, the service sector PMI. All those things are starting to show contraction. If we start talking more than 25, or if it becomes apparent that maybe it's not just 75, maybe it's 100 basis points before the end of the year, well, then the dollar's going to fall again. I mean, it's just not the kind of situation where the dollar would rally. And as it falls, I mean, it could go down to 95 or 6 from where it is now, 98. Well, it's pretty hard to imagine that gold would, if the dollar's going to break down and start moving lower again, then you would think gold would break up and start moving higher again. So I think that's how all these dots connect. It's all, in the end, it's going to be the data that is going to drive whether or not we get more than just 25 basis points.
Well, Craig, I'm glad you went there. That's exactly where I wanted to go with the dollar, the US dollar, and gold and their relationship. And as you outlined, it doesn't always have to be inverse, but lately it has as far as the correlation. But we were talking off mic a little bit about the longevity of the bull market and what could cause things to stall out. I mean, I would argue that things have been stalled out as far as the dollar and gold for the last month or two, where things have just been trending sideways to the point you made. But as far as the longevity of the bull market in the precious metals, and maybe it's not as germane to silver, but silver usually plays along with gold and the dollar to some degree. Do you think that that's the primary driver of higher prices? Because we hear people pointing to geopolitics and they're pointing to, these short-term trends and data points, but ultimately, from a longer-term basis, what causes gold to keep going higher in your outlook?
Well, you might recall we discussed this back in January when we were going over my forecast for this year. And I write those so that I can remember what I was thinking at the beginning of the year and figure out what I got wrong. And what I figured out I got wrong last year, when gold rallied more than I anticipated, was this ongoing central bank demand. And that it seemed as if every time the price wanted to correct, suddenly all these dip buyers had come in, and that, on that physical demand level in tonnage size, not you and me and the people listening, going out and buying another gold eagle, but the tonnage coming, where you see these reports month after month. And I think the central bank demand has slowed a little bit this year from the torrid pace of the last three, but it continues. So, what underpins that bull market in these right is not so much a falling dollar. You can pull up, gosh, you can go back 30 years, if you maybe just want to start 25, 28 years ago with the introduction of the euro, whatever. And you can see the dollar index just kind of hovers around 100. Goes up, goes down, but you just draw a line right down the middle and there it is. And you can pick out points in the past when it was, what is it today, 98? Over all these different decades, when you can look at gold and see, well, it's gone from 300 to 3,300. So there are periods like this where everything kind of goes sideways, and you get these more direct correlations between gold and the dollar. But there's long term, it's not really there. And so what underpins this current bull market is that central bank physical demand that kind of is precluding sharp sell-offs. And I just would invite anybody. I had a chart I shared over the weekend in a podcast on my site, the weekly chart. And you can use spot gold if you want to look at it. There have been, it's been, really about a 2-year run now. I mean, things really took off September, October of 2023, and price was $1,800, $1,900. Things really took off then. This is the fourth, about 3-month consolidation period that we've been in. And the previous three, man, once it broke out, the run was 15, 20% each time. So a falling dollar, to connect all these dots, would inspire, if you will, the pre-programmed algorithm, computer-based hedge funds, whatever, to buy more futures. Central bank demand keeps soaking up the physical. You break out, a new rush of buyers comes in, and up we go, and we'd have broken our fourth consolidation in the last 2 years. At least that's how it looks from here.
Yeah, this consolidation, I think that's the biggest question. Where is the break going to come? Is it up? Is it down? And when is that break going to come? One thing that's also interesting so far this year is the inflows, the record amounts of money coming into the physical ETFs for gold. We're on pace to come close to 2020 levels, which was a huge spike higher. And this is after, I believe, 3, maybe 4 years of net outflows from the physical gold ETFs. What do you take away from that aspect where investors that they are piling into the gold ETFs?
Yeah, I don't know what to make. I've never really known what to make of those things. To me, I've always thought of them as kind of a flywheel for the authorized participants of those ETFs, which are the bullion banks. They custodian that gold and silver too in London, which is the physical trading hub of the world. And it just seems like a ready-made store of metal that they can tap into, almost like the London gold pool in a way. I mean, if they get a little short of physical metal, they can get a basket of shares, they can sell it, and they can get some metal out, and then they can put it back in at a later date when they get the metal, and they get the metal back in their hands. Do you look at the ETFs in general? You see, I saw a chart, that the combined dollar amount in something like the GLD is twice, what it used to be, but it's also because the price is double. The actual tonnage, which is, I guess, what you're getting at, Corey, is actually still down from where it was, the highs back in 2020. So again, I guess what I'm getting at, I never really know if you, at least in my eyes, if you can accurately determine retail demand through volumes or trading volume or market cap of some of those ETFs. It's interesting. I see headlines, of big investors and institutions wanting the gold price exposure, that sort of thing. But whether that is directly leading to an impact of price, the way the physical demand of the central banks, I mean, they're buying the actual thing. They're not buying any ETFs. I think that is still the biggest driver in having an impact on price, week over week, month over month. I just don't know the proper way, and if the ETFs are the proper way to measure retail. I could be dead wrong. But that's just how I've always looked at it.
Well, Craig, speaking of ETFs and the precious metals, when we look over at something like GDX or even GDXJ, we have seen that the gold equities, and those are mostly the larger producers that are in those ETFs or the mid tiers in the GDXJ, they have been doing incredibly well, even despite a sideways channel in gold market. And it's because, they've continued to improve as companies by paying down debt, by buying back shares, by making acquisitions, or just building up cash on their balance sheet. So people have been on an ETF basis, at least buying into the gold producers, and it seems to be a positive trend. What's your take on the gold equities?
Yeah, excuse me. I think you could probably look at I would just pick one, GDX, as an interesting proxy because, I mean, you guys are experts on the mining sector, but there aren't a whole lot of experts out there, especially in the generalist category. Somebody calls up their stockbroker on a Tuesday morning and says, "Hey, I'm thinking we should get involved and maybe we should get some gold or, get a mining stock or something." And that guy reaches into his credenza and looks to see if his company, his investment bank, has put out any research on any gold miners. Maybe they follow Newmont or something. And so so then it's reflexively, well, I don't know much about this. You don't know much about this. Let's just buy an ETF and have some exposure to the sector that way. So I do think you can kind of measure that through, if the flows into the GDX, that GDXJ are positive, you can kind of measure some sentiment that way. And it really exploded. I saw a chart last week of the flow into the GDX that, when we had that huge week, what, a 15% up week or 11% up week 2 weeks ago, big push of new flow of funds into those ETFs. So we'll see if that continues. I can also look at those big producers as kind of a proxy for the gold price. We're now, well, heck, guys, we're halfway through the third quarter now that we've reached mid-August. So the gold price continues to linger here around 3,350, 3,400. That's pretty close, maybe a little higher than the average recognized sale price for most of the mining companies in the second quarter. And as you said, Shad, they just printing money at these levels and doing so much with it to improve their balance sheets and everything else. So now we're halfway through the quarter. Gold price continues to hang in there. You can only imagine how great the earnings should be next quarter. And so we may just continue to see more flow of funds coming in and pushing things higher. That GDX, has one last thing. You go back and look at the monthly chart from the last big bull market in gold from 2011, 12, 10, 11, and 12. And there is about a picture perfect head and shoulder top on that thing. The shoulders are at 55 and the head is at 65. Well, now the GDX has gotten above 55 for a couple weeks in a row. Makes you think it's going to 65. Oh, it's a massive double top, and maybe it will be. But that's another, 10, 12% from here. That's a tradable thing. And if it's going up another 10 or 12%, if that does actually happen, what does that tell you? That gold and silver are probably doing it at the same time. And if gold and silver are going up later this month and into September, let's wrap it all the way back to the beginning. What does that mean that Powell said? So we'll see if all those dots connect. But in the overlying big picture, yeah, I think everything remains in an uptrend and a bull market on all the different terms, intermediate, short, and long. And we'll just see how long they can keep going.
The thing that blows my mind is some of the stats I've seen in terms of fund flows into or out of GDX is over the last year, it's still negative about $3 billion, almost $4 billion US out of GDX. It's the assets under management that have continued to grow. So maybe it is investors buying the underlying stocks and pushing that higher. I'm getting these stats from TradingView. So if anybody has any other data on these fund flows, please send that over. But it blows my mind that we're just not seeing more people simply pile into GDX when investors are going into GLD and other physical ETFs. But Craig, what about this revaluation that we have seen almost across the board in the stocks? Even the juniors have been revalued. You look at a short-term chart, really under a year, and some just in the last few months of these equities, they've doubled, some tripled, some even gone up 5 to 8 to 10 times. Some are at 52-week highs. Most are at 52-week highs. Some are at all-time highs. Some are also still, if you go to a long-term chart, barely a blip on the screen, albeit a 52-week high, but still well off of their highs of, let's say, a decade plus ago. What do you take from the revaluation broadly that we have seen in the sector from the large down to the small companies?
Well, this is going to kind of seem like a flimsy answer, I think, but it's really there's two sides of it. You can look at it and go, okay, this company used to be a $500 million company, and now it's a $1 billion company. And oh my God, how can that be $1 billion company for a market cap? That seems crazy, and maybe at an all-time high. So you think, well, okay, so it's probably about as far as it's going to go, and it's due for a pullback. But then you look at other sectors. I don't want to just focus on the Mag 7 or the Great 10 or whatever. But you can look at that and you go, wait a second, how can Nvidia be a $4 trillion company and constantly moving to new all-time highs? I mean, money just keeps pouring in. So, like I said, I don't mean to give kind of a wishy-washy, it could be one or the other. But I think it just depends on how, where the money's going to come from in the future. And if gold keeps going up, like I said, in the chart would sure suggest, the longer term chart would sure suggest that next up leg is coming. And more and more people are going to start thinking that gold price is going to stay here and continue keep on going higher. And then they're going to start looking more favorably on the mining sectors, and more money is going to come in. And the shares are just going to get even higher valuations to them. And so, like Nvidia and Apple and, all those tech companies. So we shall see, again, wrapping it back to the beginning, if Powell sets a hawkish tone on Friday and the dollar soars and gold starts to fall and, goes back toward the bottom of its range, 3,200 or so, then mining share investors might go, you know what, Newmont's not going to make as much money in the third quarter as they made in the second. I think go ahead and sell. So, again, I keep referring back to this big event on Friday, and maybe it'll be a non-deal. But the next couple of days will be interesting because how it plays out with the dollar index and the bond market is going to impact gold, and which then impacts the shares.
Yeah, we'll see what the Fed does. But either way, hey, this bull market for precious metals has really been textbook. Gold led the way. The big stocks moved up, and now the money's filtered down to the juniors as gold has moved sideways, kind of in a boring nature for the last now almost 5 months. Again, it all circles back around to what's that next leg higher. If gold can make another leg higher, then it's almost like we reset this bull market and just keep running ahead. I think that's what a lot of our listeners are hoping for, including ourselves. So, hey, Craig, great chatting with you. Always fun to chat on Mondays, especially when we have something to look ahead to, this week being that Jackson Hole meeting. If you want to follow along with Craig, click that link in the show notes or simply search TF Metals Report. You'll find his website. Craig, thanks as always for your time today.
Hey, you bet, guys. Have a good week.